Welcome to tracking and reviewing trades, a vital step in improving your trading performance. Many traders focus heavily on placing trades, but overlook the importance of reviewing them. By tracking your trades, you gain insights into what's working, what's not, and how to refine your strategy for better results. In this session, we'll cover why tracking trades is essential, what to record in your trade journal, how to analyze your trades, identifying patterns and areas for improvement. Let's dive into why trade review is your secret weapon for consistent growth. Why tracking trades matters. Building awareness. A trade journal reveals patterns in your decision-making. You can identify whether losses are caused by market conditions or errors in execution. Example, after 20 trades, you realize you consistently close winners too early or let losses run. Accountability and discipline. Recording trades enforces discipline by making you accountable for every action. It encourages thoughtful entries and exits, reducing impulsive trading. Measuring performance over time. A journal lets you track progress, measure win rates, and monitor risk-reward ratios. Example, over 3 months, you discover that trades with a 1-to-2 risk-reward ratio have the highest success rate. What to record in a trade journal. Basic trade details, date, time of entry and exit, asset, e.g. Euro USD, Tesla stock, order type, market, limit, stop loss, trade size, lot size, entry and exit points. Record the exact price where you entered and exited the trade. Include stop loss and take profit levels. Reason for entering the trade. Describe the logic behind the trade. Technical, e.g. RSI over 70, moving average crossover. Fundamental, e.g. earnings report, economic news. Example, entered buy trade at support level after price rejection on 4-hour chart. Emotions and observations. Note how you felt during the trade. Confident, anxious, rushed. Emotional awareness helps you identify psychological patterns affecting performance. Outcome and reflection. Was the trade profitable? Review mistakes and successes. Example, close trade early out of fear, missing the full profit target. Analyzing trade data. Look for patterns. Review multiple trades to spot recurring patterns. Identify common traits in both winning and losing trades. Example, losing trades often result from late entries, while winners happen after price pullbacks. Calculate win rate and profitability. Track how many trades were profitable out of total trades. Aim for consistent profitability, not just individual big wins. Evaluate risk-reward ratios. Compare trades with different risk-reward setups. Determine if a 1-2 or 1-3 ratio consistently leads to better performance. Example analysis. 30 trades logged, 18 winners, 12 losers. Average risk-reward 1-2. Win rate 60%, a solid foundation for long-term growth. Refining your strategy based on reviews. Identify areas for improvement. Look at losing trades to find weaknesses. Were stop losses too tight? Did you miss important indicators? Adjust your approach to reduce avoidable losses. Strengthen what works. Focus on setups and strategies that consistently generate profits. If trend-following strategies outperform range-bound setups, shift focus to trending markets. Adjust risk management. If frequent stop-loss hits occur, consider wider stop losses or smaller position sizes. Conclusion. Tracking and reviewing trades isn't just a task, it's the foundation for continuous growth. By analyzing past trades, you gain insight into your strengths and weaknesses, allowing you to refine your strategy and improve performance. Next steps. Start a simple trading journal if you haven't already. Log every trade for the next month and review it weekly. Use your findings to adjust your trading plan. Consistency comes from learning from your experiences. Happy trading!